Hello and welcome everyone to Amrite Education. We are happy to have you all join us as we present today's webinar on unemployment insurance, managing key issues in response to COVID-19 implications. At this time, I would like to introduce today's presenter, Ronald Adler. Ronald Adler is the President CEO of Ladd & Associates Incorporation, a veteran-owned human resource management consulting firm specializing in HR audits, employment practices, liability risk management, HR metrics, and benchmarking strategic HR business issues and unemployment insurance issues. Mr. Adler has more than 40 plus years of HR consulting experience working with US and international firms, small businesses and nonprofits, printers, insurance companies and brokers, and employer organizations. Mr. Adler is an internationally recognized thought leader on HR auditing and is the developer of the Employment Labor Law Audit, the nation's leading HR auditing and employment practices liability risk assessment tool. Mr. Adler is an adjunct professor at Villanova University's graduate program in human resources development and teaches courses on HR auditing and HR management. He is also a certified instructor for the CPCU Society and conducts courses on employment practices liabilities. Mr. Adler has served on 2 national task forces developing professional standards in human capital measurement and performance management. He is a member of the Institute of Internal Auditors, also a member of the Society for Human Resource Management, and serves as a subject matter expert to SHRM on HR metrics and workplace issues. He is a member of the Maryland Chamber of Commerce and chairs the Chamber's Unemployment Insurance Subcommittee. Mr. Adler has also been a member of U.S. Chamber and its Labor Relations Committee. Before we start, we need to let you know that we are going to hold off answering any questions until the presentation is complete. 10 minutes will be allotted for the Q&A towards the end of the session. Participants will be placed on mute during the training program. However, if you want to submit any question, you may do so anytime by clicking and typing in the text field in the bottom right-hand corner of your screen. At the end of the presentation, we will review the questions in the order they were received, and Ronald will answer the received questions accordingly. If for any reason you get logged out of this teleconference, kindly follow the same procedure to join in again or contact our customer support. Once again, thank you all for joining the webinar. Let's get started with this presentation. I request Ronald to take over from here. Over to you, Ronald.
Well, thank you, and welcome to our audience. So today we'll be talking about unemployment insurance. This is a key issue right now as states are beginning to send out their 2021 tax rate notices for unemployment insurance purposes. A few states already have, but the majority of states are getting ready to send them out. So we'll be talking about the tax issues, the financing issues of unemployment. But let's start with looking at where we are right now. Maybe many of you saw the news this morning that 900,000 additional new regular unemployment insurance claims were filed for last week. So that's in addition to the claims we had. And in addition to that, 423,000 people filed under the Pandemic Unemployment Assistance Program, which was created to help individuals who are gig employees and who are self-employed. So significant numbers of individuals are collecting unemployment insurance. And to remember that a year ago, in February of 2020, we had reached a historic low, or tied a historic low, and we had unemployment at 3.5%. We're significantly higher than that now, and many people are concerned that the rates aren't going down. We're at historic levels. So unemployment insurance is certainly in the news, but from a manager standpoint, we're going to see how it affects your organization, how it affects perhaps you if you're in finance or in human resources, and some of the things you may want to do or be able to do to help control the cost. So with that, let's get started then. So as you perhaps have already gotten your 2021 tax rate or you're getting prepared, as you compare it to your 2020 tax rate, has it gone up, has it stayed the same, or has it gone down? And for the vast majority of people this year, as they look at their 2020 state unemployment insurance tax rates, they're going to see that the rates have gone up. Their tax rates have gone up. So this is just something we need to be prepared for. So when we look at the 2020 rates, the 21 rates, we see they're going up. But even more important is we look at 2022, as we look at next year. We're going to see rates go up even higher because the impact of the pandemic didn't really affect the 2021 rates to a great extent, 1/4 in most states. But now the full effect of this unemployment that we're seeing will affect the 2022 rates. So unfortunately, the future does not look good from the standpoint of employer tax rates. So as we think of then and look at the where we are, we see that the coronavirus has significantly impacted unemployment tax rates. I show here that the November rate was 6.7%. Of course, it stayed the same. And overall, there are now more than 40 million workers who have become unemployed, and many still remain unemployed. So, a significant issue for the economy, for individual employers, and for employees. So, as we now look at the first quarter of 2021, we see that employers are issuing their tax rates, and we're going to see, as I noted, then the tax rates for 2021, and then what happens. And it happened in the remainder of 2020, what happens in the first 2 quarters of 2021, affecting the 2022 tax rates. So as I mentioned, tax rates and tax liabilities will be going up for at least the foreseeable future. So as we look then at perhaps how individual states are doing, we see that the states with for December that had the highest unemployment rates were New Jersey had a 10.2 unemployment rate, and Hawaii had a 10.1, as did Nevada. Let's compare that to the states with the lowest unemployment rate, which is Nebraska 3.1 and Vermont 3.1. So if you look at this, you see a significant difference between the highest and lowest states with unemployment. We also note that 26 states had rates lower than the U.S. average of 6.7%. 11 states in D.C. had rates higher, and 13 states were just about on average for this period. Important information then. I just also note that most states now, virtually all states, have now triggered on for extended benefits. And what that means is that in addition to the normal unemployment duration of 26 weeks virtually in all states, when extended benefits trigger on, individuals in those states can get an additional 13 weeks of benefits, and this is under the regular programs. Of course, with the pandemic and the legislation that was passed then, individuals were able to collect an additional 13 weeks. So for many individuals going into the pandemic in March and April, it looked like they could collect anywhere from 39 to 52 weeks of benefits, which historically then looked like that individuals were at least protected from the unemployment insurance perspective going into the future. But now we're seeing that perhaps that was not enough, that the 52 weeks was not a long enough period to protect workers going forward. And thus now with the Biden administration now in place, we're seeing new legislation to pass additional UI benefits for workers unemployed. So as we think then about unemployment, let's look at then some of the exposure factors, things that cause tax rates to go up, cause tax liability to increase, things that affect the unemployment insurance system. Well, first thing we note is that from an organizational perspective, COVID-19, the pandemic, is something now we're living with, and it doesn't look like it's going to be solved anytime soon. I know we're talking about the vaccines coming out, and more and more people beginning to get the vaccine, but from an unemployment insurance standpoint, looks like we've got a problem, and so something we need to consider. Additionally, as we talk with employers and talk about this issue, we're beginning to realize that COVID-19 hasn't been the first, and it will probably not be the last medical issue we have to address going forward. So it's been 100 years since the last pandemic, but it's certainly unlikely that the next pandemic will take 100 years before it affects individuals in the workplace. So something now we're going to have to address from both a governmental and individual employer perspective on how do we address this in the future. Of course, one of the issues then from an organizational consideration, irrespective of the pandemic, is the location where you are located. Where do your employees work? And so, because of the nature of the federal state system, where you're located has an impact on the amount of taxes and the liability you face for unemployment insurance purposes. And we'll go into that in a few minutes. But just remember, where your employment is, the states that you're in, can have a significant impact on the amount of taxes you're paying. Another issue is one of the type of workers that you have. And the question is, do you have workers in the form of employees, or do you have workers in the form of independent contractors? And one of the things that we've noted that's been true now for the last couple of years is more and more employers are trying to, as they readjust their workplace and workforce, are converting individuals from employees to independent contractor status. And then there's a recognition and a realization by employers that's a way of saving resources, of saving their liability. And so many employers have actually done this. And we're seeing a lot of discussion now. This has been going on now for at least a year. Discussion of, are individuals working for your organization being classified properly? Are you treating them properly? Are you treating them as employees or independent contractors? Because if they're employees, then you have other liabilities. And in this case, you have not only wage and workers' comp liability, but you also have unemployment insurance liabilities if they're employees and you separate them. If they're independent contractors, then these benefits do not apply to them. And so there's a decision that employers have to make then. Do they treat these individuals as employees or independent contractors? And the question is then, what does the law say? How does the law treat these individuals from your perspective, so you can properly classify them? Well, many employers have said, well, look, perhaps the law is not as clear as they'd like it to be, or perhaps they're pushing the envelope about how they're going to classify these individuals. And many employers have classified individuals as independent contractors to see what happens. Well, what's happening is that in many cases, employers are being told that they improperly classified individuals as independent contractors. And part of the problem is that there's not just one standard, one place you can determine whether the person falls into the category of employee or independent contractor, because now you get to federal issues versus the state issues. You've probably heard that as part of the Trump administration's final activities, one of the things they did was come out with the Department of Labor determination about who is an independent contractor, and trying to to make clearer for employers how employers should determine whether an individual falls in this independent contractor or employee status. And so that's now out, and perhaps maybe it will be changed by the Biden administration, but that's still now what the available information that employers have. Additionally, at the federal level, federal courts as well as the Supreme Court have also come out with a determination of who falls under this category of independent contractor versus employee, and then so has the Internal Revenue Service. So employers have one source of information to make this determination about who is an independent contractor versus who is an employee. But the starting point for this whole discussion, at least from the federal level, is that when an individual comes to work for your organization, you have to assume that the person is an employee unless they can prove that they're an independent contractor. So that's the assumption that's been made. Is an individual who comes to work for your organization is an employee unless you can show there's a reason why they should not be an employee, in other words, an independent contractor. Well, that's at the federal level. And many employers then have relied on that in their dealings with these individuals. But what happens then is that, at least for unemployment insurance purposes, that there's can be a significant difference between the federal definition and the state definition. And employers are finding that their determination, their decision of treatment of individuals as independent contractors was incorrect. And so, as an example, we had a client that had individuals that they treated as employees for a long period of time. The organization was going through adjustments and reorganizing, and they recognized that certain parts of their business really were no longer substantial for the growth of their business. They still needed someone to do some of these jobs, but it wasn't going to be part of what they saw was going forward. And so they decided to make these individuals doing these particular jobs as independent contractors. And so that's the agreement that they made. And these individuals went along with this, decided, okay, they could live with that. And so they were treated as independent contractors. The organization got to the point where they were making significant changes and realized they no longer needed these individuals. And so they separated these individuals. They said, okay, the contract is over. We don't need you anymore. And so what typically happens then, with whether it's an employee or independent contractor, the individual files for unemployment insurance or state unemployment insurance. And the state has now a form that's filled out by this individual saying he worked for your company. They then send the form to the company and say, okay, this person has filed a claim against you. Please give us various information about his work for your company. And as typical then, this employer responded by saying, well, that's nice, except this person was not an employee, and so basically we don't have to provide this information. The state then said, well, we need to make that decision. And what then happens is the state typically sends an auditor to the employer to make this determination as to whether or not the individual was actually an employee or independent contractor. And in this particular case, the state ruled that not only was this person really an employee, but everyone similarly situated was also an employee, and thus they then said, okay, anyone you treated as an independent contractor, you treated incorrectly, and you now owe us back taxes for the unemployment insurance purposes that you didn't pay on these individuals. And so the employer said, well, okay, so we'll pay some taxes. The taxes weren't that high on these individuals, and thought then the issue was over. but the issue only just begins, because then what happens is the State Department of Labor then contacts through working relationship with the federal government and notifies both Wage and Hour and the Internal Revenue Service that they have reclassified certain individuals. IRS and the Wage and Hour then came into this organization, looked at the issue and said, okay, these people were employees, not independent contractors. You owe now us federal taxes and federal liability for the way you treated these individuals. So then the organization had to deal with that. And they thought then that they finally got this taken care of when in comes the Immigration Service. And the Immigration Service says, okay, we understand we have some issues here. We're going to look at all your I-9s, but we want to start with individuals who were classified as independent contractors who are now employees. We want to see their I-9s. Well, of course, the employer didn't have I-9s on these individuals because they were treated as independent contractors. And so significant liability from an immigration perspective because the employer didn't have I-9s on these individuals. So the message for employers is understanding this difference between employee and independent contractor is a critical issue as you go forward and you make this determination. You can obviously save money if the person really is an independent contractor, but if you incorrectly identify them, you can have significant liability going forward. So another issue from an organizational standpoint for unemployment, of course, it affects other types of issues also, but from an unemployment insurance purpose, often we see that the state unemployment insurance decision based on their way of identifying, and we'll go through the test that states use in a couple minutes, can have significant tax liability for the employer. We also need to think then from an organizational standpoint about employment stabilization policy. Again, as employers are looking at this issue, as we went into the pandemic, in response to the pandemic, back in March and April, many thought that this was going to be a short-term event, that individuals would not be unemployed for that long, and so they were looking for ways of not necessarily separating individuals, perhaps putting them on reduction in force rather than a layoff. And so many of those issues became, so options to long-term fixed separations became an issue, and that's an important part of unemployment insurance. Unemployment is designed to reward employers that stabilize employment, but penalize them for those that don't stabilize employment. So an important issue then, as we go forward, in how you address separations that must occur because of various conditions. Of course, part of the conditions then is the financing aspect. And so one of the issues from an unemployment insurance perspective is unemployment insurance issues are a tax. And so we talk about tax savings. And using and being very specific about UI financing, UI taxing can either save or perhaps cost you money from a tax saving position. So one of the things you want to look at is you get your tax rate notice for 2021. Are you taking advantage of the various tax-saving provisions in the law? Something to pay attention to. Perhaps more so than it was last year, 2020, when many employers were at the minimum rate, and so there's not too much they can do. But as a result now of the pandemic, most employers across the country now are no longer at the minimum rate and will unlikely be at the minimum rate going into the next few years. So some tax-saving provisions now become an issue. And, of course, all that results then about claims benefit administration. What happens when a person leaves? What happens when a person files a claim against you? are you accepting the claim? Because if you accept the claim, and some claims you need to accept because if there's a layoff, there's not much you can do about it. But if there are people who voluntarily quit your organization or were discharged, those claims can cost you money in the form of tax liability that you're going to face in the future. So important issues now as we go forward in looking at unemployment insurance. So as we think then about the risks that we're facing from an unemployment insurance standpoint, we see that, first of all, there are higher taxes, and we talked about this taxes. If your organization is a governmental agency or a 501c3 nonprofit, in addition to taxes, which all other employers have to be, you have this option. So governmental agencies and 501c3 nonprofits have an option of either paying taxes that's in the taxing system or reimbursing the state for any liability that the state may have, that the organization may have. And so if the organization has no one leaving, has no one filing a claim, under the taxation method, they still have a tax because you always have a minimum tax. On the reimbursement method, if there's no claims coming in, the employer has no liability. So traditionally, the reimbursement method has been the method that many nonprofits and governmental agencies have chosen to finance unemployment insurance. The problem is that's worked well during good conditions, but in the pandemic, you have to pay the state dollar for dollar for everything collected. So that can become very expensive very quickly. And so this is an annual decision that you have to make if you're a nonprofit. And so one perhaps you hadn't paid attention to previously, something now if you're a reimbursing employer, you're certainly paying attention to because you're seeing the tax bill that you now have to pay. So an important issue, and we can talk about that if anyone has any questions on that. We also then see, as a result of turnover, we see that there are increased labor and turnover costs, something that just is a result of the separations. So separations cost liability, cost money. And so something to pay attention to. In good times, the unemployment perhaps is minimum, and you have other labor costs that you have to worry about, turnover, but something to pay attention to from the unemployment insurance perspective. Of course, with all that, then, with more claims coming in, that raises the amount of administrative costs. So maybe you had your payroll person or your HR person handling these claims, but they came in infrequently, so it wasn't a significant liability. Now, if you're a larger organization and you have significant reduction in force, the number of claims can be sizable, and so a significant increase in administrative costs can now occur. And so all this then, between the cost and the tax liability, ends up reducing the organization's profitability. And that becomes an issue then, not only for UI and for HR, but also for the finance department. Because now they're looking at the profitability, and often, at least going into this year, the reduction in profitability, the effect on profitability, was not identified because unemployment was low and the taxes were under control. So something else to look at. We also see that UI activity can trigger an audit by the UI agency, by Dollar, by IRS, or ICE. So I just mentioned these agencies in giving this example about how an audit, and increasingly by independent contractors, can trigger all these agencies coming in and conducting audits and finding you liable for payment. So something else to consider. And of course, all these UI claims particularly those that are not related to the pandemic, but caused by people quitting or being discharged, can also trigger a claim then by a plaintiff's attorney. And typically what we see then is an individual who was fired will file a claim for benefits, and of course, unbeknownst to you, if you're the employer, is responding to this claim, not recognizing whether or not the plaintiff, the former employee, has attorney, and the state agency and the plaintiff's attorney is looking at the information you and how you handle, how you respond to the state's request for the reason for separation. And even if it goes to a hearing, often there's a plaintiff's attorney in the background looking at what the state's doing. And if the state grants benefits, allows benefits to be paid, and you don't appeal it when you should appeal it, and it becomes final then something called the collateral estoppel effect will take effect. And that means that it's the state agency rule that you fired the individual for a reason that perhaps is not disqualifying. But you want to say, well, we don't want to go through this and go to more hearings and stuff. We'll just let the guy collect. Once that becomes final, then that becomes a reason for separation. And if it's untrue, you can find an unemployment insurance claim becoming an employment liability claim against your account. So you have to be very careful, particularly when you fire an individual or someone quits, that they file for unemployment insurance, that you protect the reason for separation. Don't automatically accept the fact that, all right, well, unemployment is not going to be too expensive, we'll just let him collect and he'll go away. Because typically they don't go away. And they just use that information for future liability. So something to pay attention to. And so as we continue then these related risks, we also find then that your UI policies and practices, particularly if it has a discriminatory effect on individuals, on women, on minorities, that can also result in liability to your organization. And so something to pay attention to. We're also concerned about UI policies and practices that are not aligned with your business objectives. And so that's something that we're seeing now, particularly in light of the pandemic, is organizations now take a step back and say, look, this is the way we're doing it. As we ended last year, we were doing fine. As we approached this year, in January and February, things were positive, and then March and April hit. We need to reorganize our organization. We need to think about things differently, and often all that discussion fails to consider the impact that will have on their unemployment insurance practices and liability. And so often there's more important things than the UI liability, but something at least should be said, okay, we're restructuring our organization. Here's the potential impact it will have. We can live with it, or perhaps we need to find some way to control it. But it should be at least a consideration in your planning activity. And of course, one of the things now we're also seeing is that with this activity, particularly in light of the amount of unemployment, we're also seeing that unemployment insurance issues, both whether people qualify for benefits or employer action in response to the claims, is getting greater press attention. And with press attention, often employers don't necessarily like the attention that they're getting, because often the press does not cover them from their perspective. It's from the individual, the claimant's perspective. So something to pay attention to. So a quick update of then some December 2020 data. This was the latest that's available. So just here's some numbers. We see that the unemployment rate was 6.7% in December. That compares to the February rate of 3.5%, so a significant increase from February of last year to just through the end of the year in December. That meant that there were 10.7 million unemployed workers. That of that number, 3 million were laid off. That there were 3.4 million permanent job losers. So there wasn't an expectation they were coming back to work, and that compared to in February of 1.3 million. So that's 2 million workers that are now permanently laid off, and they're going to collect their full unemployment, and they're probably still looking for jobs. So that creates ongoing liability for the organization. The longer these individuals don't have a job, can't find a job, and so an issue. We then have job openings outnumber workers by 1.4 million. We have the national number of unemployed workers at 23 million, which is up from 7.2 million. We have the national long-term unemployment rate. When by unemployment we mean more individuals who were unemployed for more than 27 weeks, as I mentioned. An individual in most states can qualify for 26 weeks of benefits. That's a regular unemployment. If they're still unemployed, then they get classified as long-term unemployment, and that has now increased to 4 million workers. When looking at breakout by various categories, we see that white workers had 6% unemployment rate, black workers had 9.9%, Asian 5.9%, and Hispanics 9.3%. The government also breaks it out by men at 6.4%, women at 6.3%, and teenagers at 16%. So in December, these were some of the data behind the national number. Then additionally, some other numbers, we won't go into details here. We see that the labor force participation rate was 61.5%, which was 1.9% lower than in February. So again, we had the unemployment rate could actually be higher if these individuals who were actually participating in the labor force. Because once they drop out of the labor force participation, they're no longer counted as unemployed. So the unemployment rate could actually be higher than the rate we're talking about. The average work week for all employees was unchanged at 34.2 hours. The number of workers who were employed part-time but preferred full-time work, so those individuals who weren't totally laid off but still had a job but were partially laid off, that totaled 6.2 million. The number of marginally attached to the labor force was 1.9 million. The number of workers who did not work or worked fewer than hours because of the pandemic. So this is a category of workers just who were affected by the pandemic, with 15.1 million. The number of workers working that were teleworking. This is a new category that the Department of Labor is keeping. So 23.7% of those unemployed, or those that they were tracking, were teleworking because of the pandemic. Then we have the average hourly wage was $29.81. The average work week was 34.7 hours. The average duration of unemployment benefits was 15.36 weeks, and it's actually increasing. So unemployment, the duration of unemployment is significantly increasing. People are not going back to work as quickly as possible. The average weekly benefit amount for unemployment insurance is $352, and of course, as you go across the country, significant differences between the weekly benefit amounts in Massachusetts versus Alabama. So an issue. And the current exhaustion rate, the number of people exceeding 26 weeks of benefits, is now at 36.35%. So over a third of individuals now collecting unemployment benefits are exhausting their 26 weeks of benefits. So as we looked at the specifics of the unemployment insurance, as I mentioned earlier, the program is a federal state program. So employers pay both federal tax and state tax. So let's look at these issues. So first of all, the federal tax. And the federal tax is a rather simple calculation. And for 2021, the federal tax liability that employees collect, actually don't collect, but the amount that are charged to employers is $42. So you pay $42 for each individual, for each employee that your organization pays, and that's determined by the tax rate of 6.6% times the first $7,000 that each employee earns. So right now, since January, you've been keeping track of how much each individual earns, and at the end of the first quarter, you will pay 0.6% of that money. And often they earn $7,000 in the first quarter. So typically for federal unemployment, once the person hits $7,000, then you have no further liability for that year on that individual. And so not a significant liability from a federal tax purpose. But important to note that, first of all, there's greater numbers now because of the recession being laid off. And so if you lay off a person and you then hire someone else to fill that position, you now start to tax over again. So if you have an individual that worked the whole year, you pay the $42 once if they earn more than $7,000. If they leave either voluntarily or because of action you're taking, and you hire someone else, you now pay the tax all over again. So the potential for tax liability can be affected by your action and how you respond to the recession. But additionally, the question is, what happens with this federal tax? Is there any chance that the tax is going up, respond to the political environment of the system? As we know, this political system has just changed. And so as we think about what's going to happen from a federal perspective, we see that there's a couple of things that can happen. First of all, the federal tax rate of 0.6 can change. It changed once before, back in the 70s and 80s. The tax rate went from 0.6 to 0.8, and that lasted for years, and then it went off about 10 years ago now. It went back to 0.6%, but the federal government can increase the federal tax rate at any time. So one of the things that we're looking at is that going to happen? Will the federal government change the tax rate that employers have paid? The other thing that can happen is, of course, the taxable wage base. And as I noted, the federal taxable wage base is $7,000. And from a historic standpoint, the federal unemployment insurance system was started back in the 1930s. So it's over, it's coming to 100 years now that we've had the unemployment insurance system. And back then it was started with the Social Security Act, and the taxable wage base for both Social Security and unemployment, federal unemployment, was $3,000. So that lasted, and then, of course, we know what's happened to the FICA tax and wage base, Social Security tax and wage base. That's increased over time, but that's not true for unemployment insurance. The tax and wage base went from $3,000 to $4,200 in the 70s, and then went from $4,200 to $7,000 in the 1980s. It hasn't changed since then. So we've had a $7,000 tax and wage base for federal unemployment taxes since the 1980s, and it's certainly potential for Congress to pass that change. One of the changes that has been discussed is increasing the tax and wage base from $7,000 to $14,000. So if that happens, then we look at how the states have what their tax and wage base is, and we see that a number of states have taxable wages below $14,000, and so if you're on this list and the tax and wage base goes to $14,000, you can see then that you will have to raise your tax and wage base for federal purposes. And if you raise it for federal purposes, you also have to raise it for state purposes. So possible change. There's nothing. The new administration just came into being yesterday, so they haven't touched UI yet. But this is one of the issues. Then we're likely to see, particularly with unemployment continuing at the rate that it is, to see a greater interest in raising the federal UI tax on employers. And so as we think that the federal tax, we see that there's a possible increase in state tax UI liability because of this relationship where states have to have a taxable wage base at least equal to the federal tax wage base. So some states have, and then we'll go through this in a minute, some states have a taxable wage base of $7,000. Others have much higher. The law only requires that the state have a tax wage base equal to the federal tax wage base. So if the state has, if the federal government raises their tax wage base, the states will have to match it. Additionally, one of the things that, from a federal standpoint, that the federal government is looking at is what is the balance that the states have in their trust fund. Okay, so the trust fund is the amount of state taxes that employers pay in that go into this fund to pay for benefits that are collected. And the goal is that states have a trust fund equal to 12 months of benefits. And of course, that's going to vary among the states. Some states don't necessarily have that. Matter of fact, many states don't have a trust fund equal to 12 months of benefit. And so one of the issues that the federal government will be looking at is perhaps requiring that the states meet this trust fund balance. And so then the question is, well, how do states do that? Well, states can do that a couple ways. They can increase their taxable wage base, so from $7,000 or higher to whatever the federal government says they should have. And one of the proposals that we've seen in the past is to raise the state taxable wage basis to $40,000. Significant increase if you're in a state at $7,000 or somewhere less than $40,000. The vast majority of states are less than $40,000. So a significant potential increase in unemployment insurance taxes if that occurs. The states can also raise their tax rate structure. And so, and each state has its own tax rate structure. They can make those changes, and perhaps the federal government will set federal standards on tax rates. The states can also impose surtaxes and say, okay, during this period of time, because of high unemployment, in addition to the regular taxes that we're charging employers, we're going to have a surtax or surcharge, additional tax. And of course, then the states could also do all of these. So a number of potential issues now that we have to face going into the future because of the high unemployment, and this is just for federal purposes. So as we consider then this federal-state program, a couple of important issues we need to talk about. So first of all, as we look at the UI program, we see that it was designed to be a counter-cyclical tool. And what I mean by that is the state, the federal government, and the states collect money to pay benefits during good times so they can pay money in bad times. And so there's this counter-cyclical nature of unemployment insurance. And that has been in effect now since for the last few years as the unemployment rates have been going down. But now the question is, have states saved enough in light of the recession, in light of where we are? So it's going to be an issue that is going to become, we're going to have more discussion on going forward. We also recognize that the purpose of unemployment insurance is to provide temporary partial wage replacement to unemployed workers who lost their job through no fault of their own. So an important part of the unemployment insurance system is that they're only paying temporary partial wage replacement to unemployed workers. So the question is it temporary or is it partial? You can see one of the things that the states are doing, the federal government doing, is adding additional money to the wage replacement issue to provide benefits to individuals. The states have traditionally shot for about 50% of the maximum wage. And so if you look at the maximum unemployment benefits, in each state it was around 50% of whatever the wages were in that state. Well, with a flat amount of $600 or now $400 that will be proposed, that's going to increase that amount to, in some states, 85%. In some cases, it rose into above the 100% mark. So some issues then from an unemployment insurance standpoint that will need to be discussed and addressed. And of course, the other issue then is we see is that benefits are paid to individuals who lost their job through no fault of their own. Well, if someone has been separated because they were laid off or discharged, their company went out of business, then there's this expectation that these people qualify for benefits, and very little discussion about them collecting. If a person is fired or voluntarily quits, then employers have a legitimate right to question whether benefits should be paid. And that's an ongoing discussion. If you're from an employer perspective, there's this feeling that individuals are collecting benefits that shouldn't collect benefits. If you're representing organized labor or from the employee standpoint, you're saying that the state is denying benefits when they shouldn't. And so this is an ongoing controversy that we face that's actually designed to be part of the system because, as you note, one of the founding principles of the federal state unemployment insurance system is that the system encourages employment stabilization through employer participating experience rating. So experience rating is a critical aspect of the unemployment insurance system. And what do I mean by experience rating? Experience rating says that unlike Social Security, where an individual, you're paying a tax on the person's wages, good, bad, different, no matter if the person earned wages, you're going to pay the Social Security tax that's due. And that was designed going back to 1935. Unemployment, even though part of that bill was determined to be different. And the feeling was that the government wanted employers not just to accept the unemployment, but to be encouraged to participate, to try to reduce unemployment. And so they did this through experience rating. So employers that can control their turnover, that protect their account, will have lower tax rates, lower tax liability than those that can't or won't. So important part of the unemployment insurance system then is experience rating. And so something that organizations, that employers, that state agencies are often trying to protect from others, that perhaps often state legislators are trying to reduce this experience rating nature so that more people collect benefits and employers protest less if it's experience rating in the system. So an ongoing discussion of the balance between experience rating and the funding of the source. Also, we note that unemployment insurance is to be forward funded, so employers are paying taxes going into the system that will be used to pay benefits in the future. And then claimants must show previous and ongoing attachment to the labor market. So when a person files for benefits, the state says, okay, have you worked before? If the person has not worked, they don't collect benefits. If they don't have if they don't have an ongoing attachment, are you currently looking for work? If the individual says, I'm not looking for work right now, they can't collect benefits. And so of the unemployment insurance system is that the individual, the claimant, show a previous and ongoing attachment to the labor market in order to collect benefits, at least be eligible to collect benefits. So that's our federal state program. So as we looked at the guiding principles, sort of to summarize what we just discussed, we see that from an unemployment insurance system, the best UI benefit is a job. So getting people back to work is the ideal from an unemployment insurance perspective. So you don't want to pay so much that the person loses the incentive to go back to work, but you want to pay them a sufficient amount that they can survive while they're looking for work. And there's this balance. And not everyone agrees where this balance is, but that's one of the issues. Second, experience rating is the best method of financing unemployment insurance program and allocating costs. So again, experience rating, something that I believe strongly in, is very important to the system and is really the best system that I've found in financing the UI program. And so we look at then from a state by state basis, how strong is the experience rating in that state. And things that reduce experience rating are always susceptible, at least from our standpoint, of being challenged. So, important issue. And the third guiding principle then is that the longer a person is unemployed, the more difficult it becomes for the person to become reemployed. We saw that 10 years ago during the recession. We've begun seeing it now, where the employer said, oh, well, you just got unemployed, you're okay, then we're looking, we need to hire someone, we'll hire you, versus someone that was unemployed 3 months ago or 6 months ago. Things have changed in the workplace. We have new technology, we have new programs. The person just unemployed is probably more capable of doing the job than someone that was employed 6 months ago. Now, whether or not that's true is not the real issue. It's the perception of the truth of that. In some cases, it will actually be true, depending on the nature of the job. So it's important then, from an unemployment insurance program perspective, that they try to get people back to work as quickly as possible, because the longer a person is unemployed, the greater the length, the greater chance he'll remain unemployed. So let's then, with that, then let's talk about individual the state program that you have to address, and this will be true then for all states as we look at your system. So when a person becomes unemployed and files for benefits, the state has a number of issues it has to address. And the first issue it has to address, and it says to the individual, okay, we need to determine your base period to see whether you qualify for benefits. So what is your base period? Okay, so the base period is defined as the first 4 of the last 5 completed calendar quarters. All right, so right now we're in the first quarter of 2021. So if someone filed a claim today, the state would say, okay, the first quarter of 2021 is not complete, so we don't count that. So starting with the 4th quarter of 2020, we count back 5 quarters. So we have 4, 3, 2, 1 of 2020, the 4th quarter of 2019. The state then counts forward 4 quarters. So beginning with the 4th quarter of 2019 and the 1st, 2nd, and 3rd quarters of 2020, that's the person's base period. And so that's the period of time that the state's going to be looking at as to whether the person's going to qualify for benefits, and they're going to look at the earnings in that period. Okay, now that's the regular method that the state uses. If a person doesn't qualify because they don't have earnings in the first 4 of the last 5, the states then as an alternative, but only if the first 4 of the last 5 doesn't apply. Look at the last 4 completed calendar quarters. They can say instead, okay, let's look at the 4 quarters in this case of someone filing a claim in January of 2021. We'll look at the 4 quarters of 2020. Okay, but that's only if the first 4 of the last 5 completed calendar quarters the individual doesn't qualify. If they qualify, then the discussion stops. That will be the period. So that's the first thing the state has to look at. The state then has to say, well, what is the benefit year? What is the period of time that the person will collect benefits? And that's a 52-week period going forward. So they typically backdate the claim to the Sunday of the week that the person filed. Then they said, okay, the benefit year now, if someone filed a claim today, they'd backdate it to Sunday and say, okay, your base period now goes from January to of 2021 until that period in 2022. And that's the period of time. You have a 52-week period to collect your 26 weeks of benefits. Okay, so once the state does that, then it says, okay, now, is this individual, does the person have earnings in 2 calendar quarters as a base period? So the state goes and looks and says, okay, what is your base period? Do you have earnings? If they have earnings, they might be monetarily eligible. And that means that if you have earnings in 2 quarters, it could be 2, if you have 2 weeks of earnings and they're in 2 different quarters, you qualify. Now, most people don't do that, have more than earnings in 2 weeks and 2 calendar quarters, but that's all it takes. Important then when the person earns wages, determine whether their monetary eligibility. Okay, if the state is assuming that the claimant is eligible monetarily, then the state says, okay, what is the non-monetary eligibility that the claimant must meet? And in order to meet non-eligibility issues, the claimant must say that they are able, available, and actively looking for work. So if the state says, okay, are you able, available, and actively looking for work, and the person says, well, I've been working hard for a long time, I'm going to take the next week or so off and just rest and relax, that person cannot collect for that week. And if he or she comes back the next week and the state will say, okay, are you able and available and actively looking for work in this coming week? And the service says, well, not really back yet. They can't collect benefits. And so after a while, then the claimant realizes making that statement saying they're not able, available, and actively looking for work means they can't collect benefits. So whether or not they really are, they quickly become able, available, and actively looking for work. So typically not much of an issue except for the first maybe week or two, but something that the claimant must show for every week they're collecting benefits. They must claim that they are able, available, and actively looking for work. The state then says, okay, we know you meet the qualification. Let's determine how much you're going to get. And so they look at their structure and say, okay, we need to determine how much your weekly benefit amount will be, and that's based on the earnings from all base period employers. So remember, we talked about the base period, the first 4, the last 5 completed calendar quarters. The state looks at all the wages earned from all the employers in their base period. So if there's only one employer, then that's obvious. That employer is going to have, then the wages from that employer will be determine the weekly benefit amount. If there are multiple employers, then the state has to identify and add up the wages from all employers. So important then amount to determine the weekly benefit amount. The state will then say, okay, and there's only 13 states that ask this question, do you have any dependents? If you have dependents in 13 states, you can also get an additional dependents allowance. And that is only in 13 states, and it can be, for instance, in Maryland, they can get a dependents allowance for up to 5 individuals that are dependents. It varies among the 13 states. It's just something, an additional amount that the person can collect in those states. Then the state says, okay, we know how much you can collect. The question is, how long can you collect? And as I said, the maximum duration in most states is 26 weeks. The question is, does everyone qualify for 26 weeks? And the answer is that in most states, the duration of benefits is a variable duration, meaning that not everyone qualifies for 26 weeks of benefits. And the amount that the duration of benefits is determined by how long you worked for in the market, how long you worked. The longer you work, the more likely you're going to collect the full entitlement. So if you work years, you'll collect the maximum amount. If you've only worked occasionally, you still have earnings of 2 calendar quarters, but you only worked occasionally, then you may not qualify for the full 26 weeks. So whatever the state says based on maybe 12 weeks, then 15 weeks, then 20 weeks, and then 26 weeks, and that's an individual state an issue. Now, in 13 states, though, there is a fixed duration. So in Maryland, if you qualify for benefits, you qualify for the maximums of 26 weeks. And that's true whether you had 2 weeks of benefits or 22 years of wages. Everyone qualifies for 26 weeks of benefits. So a difference then among the states between whether a person is going to be, how much they're going to collect, the duration of their benefits will either be variable or on a fixed basis. And then the total benefit amount then is the duration of benefits times the weekly benefit amount. And so that's the amount of money that the person can collect if totally unemployed. So if the person is it has a weekly benefit amount of $400 a week, in Maryland then they could collect 400 times 26 weeks of benefit if they're totally unemployed for the full benefit entitlement for the full 26 weeks. And each state will then make that calculation for each individual based on the weekly benefit amount and the benefit duration for each claim. So, in addition to that, some other issues. The question is, well, what happens if the person files for benefits and collects, but then goes back to work, or at least works part-time? And I noted that a number of employers are trying to keep people on maybe not on a full-time basis, but maybe on a part-time basis. Well, states then have what is referred to as a partial benefit credit. And again, this varies among the states. So each state's going to be different. And so the partial benefit credit says that if a person worked during the week, they still may be able to collect part of their weekly benefit amount. So typically the state says, okay, let's say it's a $50 per week benefit, partial benefit credit. So if the person earns $50 or less during the week, they can collect their weekly benefit amount. They collect their $50 plus their weekly benefit amount. So if a person is working, let's say they earn $50 a day, and the person works one day, earns $50, then they'll collect their $50 plus their entitlement. Let's say the entitlement is $300, so then they collect $50 plus the $300. If the person worked 2 days, okay, then the state would say, okay, the first $50 you get to keep, but the second $50 reduces your benefit amount, and so now the person collects $50 in wages, but only $250 in benefits for that week, and it's done on a week-by-week basis. And typically, by the time the person works 3 days during the week, they end up offsetting anything that they'll collect in benefits for that week, and it's done on a week-by-week basis. So in some weeks, if the person works 3 or 4 days, the person may not collect any benefits for that week, but again, the person has 52 weeks in the benefit entitlement and the benefit year to collect their 26 weeks of benefits. So it's done on a week-by-week basis. Other things that will affect the receipt of benefits if the person is collecting benefits under another state. You can only collect unemployment under one state at a time. So if a person worked in multiple states for multiple employers, then they can lose all those jobs, and they'll file in one state, and he or she can't collect under more than one state at one time, and so an issue. Severance pay. If a person collects severance pay, most states then reduce the weekly benefit amount for that week by the severance pay. So if the person is separated and has 5 weeks of severance pay, then the first 5 weeks in the benefit year, the person will not be able to collect benefits. If the person is still unemployed, they then go into their regular payment, unemployment benefits, and so the person now has 52 weeks minus the 5 weeks, now 47 weeks to collect their 26 weeks of benefits if they're still unemployed. Then you have holiday pay, vacation pay, retirement pay. Individual states will determine whether or not those are used to reduce the weekly benefit amount. Okay, so once the state does all that, makes the calculation of how much the person's going to collect and how long they're going to collect, and those issues, then the state has to say, okay, now we need to look at whether or not you collect. What is the separation issue? What disqualification may we have to apply? And so we look at the separation issue and we see that, first of all, the first separation issue is layoffs or furloughs, something we're seeing a lot of right now because of COVID-19. And if the person is laid off or furloughed or has a lack of work situation, they are going to collect benefits. And whether the employer wanted them to be disqualified or not, there's nothing the employer can do if the person is actually laid off. First issue, and that's probably the cleanest because the individual file a claim, because the state will pay benefits, and there's very little the employer can do. Second issue, the employee is discharged. Oh, well, now the state has to say, why was the employee discharged? And now the state has to determine whether or not typically there's misconduct involved in the discharge. In other words, did the employee do something that got them discharged, which then results in a disqualification? So the question is, was there misconduct by the employee that led to their discharge? If there was misconduct, then there's typically postponement of benefits, which can be from postponement of 5 to 10 weeks. And so if the individual was late, and the employer said, okay, you continue to be late, we're not going to do this anymore. If you're late again, I'm going to fire you. And of course, the person was late again, the person was fired, then they file for benefits. The state says, okay, the employee had a reason for firing you, then it gives you a 5-week postponement of benefits. So the first 5 weeks, the person can't collect. But if they're still unemployed in the 6 weeks, okay, then they now have, they can collect their benefit entitlement. And of course, we have the 52 weeks minus 5, now leaves 47. So the person would still have the opportunity to collect their 26 weeks of benefits if they remain unemployed. But they did have a disqualification. Okay. The alternative is that if the person, rather than just being late, was guilty of theft and was discharged for that reason, then if the state has a gross misconduct disqualification, then the state may say, okay, you were fired for gross misconduct, and then that means in order for you to collect benefits, you have to get a new job and earn a certain amount of benefits, and a certain amount of earnings at the new job, and lose that job through no fault of your own before you can collect benefits. So typically, if there's a gross misconduct, the individual does not collect benefits under this separation. Now they can if they find another job and they work and then they're laid off, then they could collect. But often that doesn't happen. If a person gets disqualified under gross misconduct, typically they will have to become unemployed. They have to become reemployed and earn sufficient earnings in that job, and then lose that job through no fault of their own before they can collect benefits. But if they're still doing the benefit year, once a benefit year is established, that's where they will collect benefits under. So there is that potential, but probably not very great. Now, a couple states also allow that if the person is disqualified under gross misconduct, that they lose wage credits. They lose the amount of wages and used in calculating the weekly benefit amount from that employer. Very few states do that, but that's possible, and I think there's only 2 states that have lost wage credits. So from an employer standpoint, getting someone discharged, having the discharge classified as gross misconduct is better than having it classified as misconduct, but having a misconduct is better than no disqualification at all. So then that's what employers are trying to do, is then understanding that there are certain characteristics of a gross misconduct versus a misconduct discharge, and then trying to demonstrate that's the reason for the separation, and so important issue then for employers. The third issue of separation is a voluntary quit, where the individual says, I don't want to work here anymore, or I'm not working here anymore, and they leave and then they file for benefits. As a general rule, most voluntary quits result in disqualification. Now, if a person quits because they were sexually harassed, that would not result in disqualification. So not all voluntary quits result in disqualification, but the majority do. And there's then there's a question of, well, okay, if they're going to be disqualified, how much is the disqualification? And again, it's similar to the discharge. You can have a 5 to 10 week postponement of benefits, or a denial of benefits until the person becomes reemployed and earns with the required weekly requirement. So some key issues there about discharges then. It depends very much on the type of the reason for separation. The fourth type of separation, something we don't see very much anymore, but we may see more in the future, is labor disputes. And typically in a labor dispute, if the person is locked out, in other words, the employer took the action, the individuals will be allowed to collect benefits. If, however, they're on strike, they typically will not be allowed to collect benefits. So we haven't seen much of these types of separations lately, but who knows what's going to happen coming up in the future. Another issue for employers is then what happens if they have someone that perhaps quit their job, and then the employer says, well, okay, look, we have you quit your job because of problems at home or other issues. We have a job opening. We'd like to have you come back. And they refuse the job. Then if the person is offered a suitable job and refuses it, then they can also be denied benefits that they're collecting based on their refusal. So that requires then, of course, one of the things it means is that the employer has to provide the state with information to allow the state to make the decision. So if an individual is collecting benefits and they refuse a suitable job offer, you have to make sure you notify the state. So those are some of the benefit issues. Let me go back now and talk about, from an employer standpoint, now paying for this. And, of course, we talked about the federal issues. Now looking at the state issues, we see that states now are based on experience rating. You're going to have to pay for each individual tax on the amount that they earn. And so here are the 2021 taxable wage bases for the various states. Two of them we hadn't issued yet. Tennessee and Florida and Rhode Island haven't issued as when we did this chart. Their 2021 taxable wage base, but everyone else has. And so you can see that it goes from $7,000 in Arizona, California, and Florida to $56,500 in the state of Washington. So significant variance among the states in the tax liability that employers are going to pay. And of course, this is then multiplied by the individual employer's tax liability, which is again experience rated. So it's going to change each year. So in figuring out that tax liability, we see that, as we noted, the federal tax is based as a flat rated tax. Currently it's 0.6%. So it's 0.6 times 7,000. So in order for the state then to make, or for the federal government to make changes, they're either going to have to change the taxable wage base, the 7,000, or the tax rate. Experience rate, again, from a state standpoint, states have experience rating. And from an experience rating standpoint, there are actually 4 ways that the states can use to calculate their tax rate. So the first is the reserve ratio, and that's used by 31 states. Okay, in order to calculate this rate, the state takes every tax dollar that the employer has paid in from the time the employer starts in business. Okay, so they're paying in taxes every quarter. And then once a year, then the state takes that amount that's in there from taxes the employer paid in and subtracts the benefits that have been paid out. Okay, that difference, that balance, is then divided by the taxable payroll and gives the state then a reserve ratio. Okay, and that ratio is then applied to a chart, and that determines the employer's tax rate for that year. Okay, so 31 states use this method. This is what is referred to as the reserve ratio method. The second major method is the benefit ratio. The benefit ratio doesn't look at the amount of taxes at all that you paid in the previous years. It just looks at the amount of benefits charged against your account divided by the taxable payroll. So the more benefits charged against your account, the higher your tax rate is going to be. And 17 states use the benefit ratio. So we have, in effect, 48 states that use the reserve ratio or the benefit ratio. The remaining three are, we find that Delaware and Oklahoma use the benefit wage ratio, very similar to the benefit ratio. And Alaska uses a payroll variation, which is a little bit different, so we won't discuss that right now, but another way of calculating the tax rate. So one of the things I mentioned earlier was the reimbursement method. Won't go into detail now, unless on the question, but just note that it applies to governmental agencies and 501c3 nonprofits. It requires a posting of a bond if you select this, and the UI liability that you have is not based on the tax, but the actual amount of benefits paid. So if you pay no benefits, you have no liability. If someone collects, is eligible for $400 a week, and they collect for 10 weeks, that's $4,000. That's the amount of liability you're going to have. So, significant amount of liability, but positive if you don't have any liability. So there's also no non-charging. It basically requires a risk management assessment analysis to determine whether or not this is the way to go. If you're interested, we can discuss it in more detail. Continuation with our UI financing, we see that benefit charging is then, as I mentioned earlier, proportional to the base period wages. So the amount of charges against your account is determined by the amount of wages you paid to all wages paid in the base period. If you're the only employer, then you'll have 100% of the wages paid. And if there are multiple employers, then the percent you pay will determine the liability that you face. Also, the other tax-saving provisions, one of the things that's important for employers is something called relief from charges. So if an individual is discharged and you have relief from charges in your state, then with that, the disqualification. So you had gross misconduct, so was discharged for gross misconduct. Your account then will be relieved. So even if the person meets the impediment, the condition of the disqualification, and then it collects benefits against your account, your account will not be charged in states with relief from charges. So employers in relief from charges very much like this provision of the law. Other states have joint accounts that allow multiple states to allow employers in the state to join together and have one account assigned to individual accounts. And often we see this in restaurant chains where you have maybe a McDonald's, and rather than each one being determined individually, they go into this joint account, and so they're all sharing then this liability. The good ones end up paying more, the bad ones end up paying less, but that's something that happens. There's something called transfer experience. So when one organization acquires another company, the question is, well, what happens to the experience, the UI experience from the predecessor account? And that actually becomes an important issue as part of the discussions of the merger or acquisition. Something you need to look at, because some states then automatically require the transfer experience. Other states allow you to allow a decision to be made whether you want to make the transfer. So it's an important financial issue when you do a merger acquisition. Socialized costs, the key issue now, and this is going to become an important issue going forward. Socialized costs are costs that are not charged directly to employers. So it's often referred to as linkage. So non-charging from relief from charges and that get paid significant amount, in the millions of dollars each year in the states for non-charging, effective charging. So an employer is at the maximum rate, but they're still letting people off, but the rate can't go any higher because that's the rate structure in the state. So that's a type of socialized cost. Closed accounts. We have a significant number of employers going out of business. What happens to any money collected by their former employees? What happens to the amount they collect? Well, there's no one to charge, so it becomes a closed account, and so that also is a socialized cost. And so socialized costs now are going to be significantly higher than they were last year, and of course that then adds to the tax rate of all employers. So something to pay attention to. You're not only looking at how you as an individual employer did, but you're going to be looking at the additional tax that you're going to have to pay for a socialized cost. And it's an issue that we pay attention to and comparing states. So one of the questions then is, does your organization use the services of individual that classifies as independent contractors? And we discussed this earlier, but now let's spend a little bit of time with that. So as you think about then cost control steps you should take, and we're running out of time, so we're not going to have a lot of time to go through this, but some key things I want to mention. So as your tax rate comes in this year, first thing you should do is review your tax rate notices. Again, check the whole notices. Check the address and the name that they have on the form. Don't automatically assume it's yours. Check the address, make sure they're the right address. Check your account number. Make sure they're assigning it to the right account number. They haven't changed account number. And so, important issue. If they show claims that are made against your account, check all claims. We're finding significant liability as a result of COVID-19 of fraudulent claims. And they're in the million, actually total across the country, and they're in the billions of dollars of fraudulent claims. So in addition to tax rate notices, check your quarterly charge statement to make sure that anyone on that charge statement actually worked for you. As I said, significant liability, and that's going to be affecting your your tax rates. Something we're spending more time working with clients right now, not only verifying their tax rate, but looking at these fraudulent claims. 2, ensure your classification of employees and independent contractors is correct. So I mentioned earlier that most states use what is referred to as the ABC test to determine whether the independent contractor for UI purposes is correct. So this is the ABC test. The first thing the state says is to the individual or to the employer, okay, is the individual free from direction and control over his performance? If the answer is no, then the person is not an individual, not an independent contractor, he's an employee and he don't go any further. If the answer is yes, he's free from direction and control, then the second question is the independent contractor, an individual, customarily engaged in an independent business? So, is this individual engaged in an independent business? If he works solely for a single employer and he doesn't work anything outside of that, he's not customarily engaged in an independent business, the answer is no, not an independent contractor. If the answer is yes, then the third question is the work outside of the usual course of business of the person or identity for whom the work is performed, or outside of any place of business for whom the work is performed? So the question is, if you have an individual, let's say you're an accounting firm, and it's now accounting season, and you have some accountants come in to help you do the accounting returns. Are they employees? Yes. They're not. You can't say that they're independent contractors because that's the work that you do. But if at the same time you have someone come out and you have your building and you have someone monitor, you have someone doing your lawn and your shrubbery, they're independent contractors. And so very important to understand the type of business you're in. And don't classify someone that you're just using on a part-time basis as an independent contractor. So you have to meet all three of these. If any one of these is an answer is no, the person is not an independent contractor and they have to be employees. Third, ensure your wages are reported only on covered employment. Well, most employment's covered, but so that's an issue. Ensure you have properly reported wages, so make sure you report the correct amount to each state. And one of the issues now that we're seeing is what happens if an employee doesn't work in one state, or it's not clear where they're working. What state do we report the wages? So there's a 4-part test that the states use, and this decision tree, and so let's just quickly go through that. So the first test is the employee work localized to a single state? So does the individual work at your location, perhaps I'm going to go visit a client or something else, but they work in one state. So if let's say we're in Maryland, he works in Maryland, he or she works in Maryland, so maybe sometimes he works at home, he may go visit a client, but the first test then is his work is localized in a single state, should report it to Maryland. If the answer is no, so let's say then that he doesn't work just in Maryland, he works in Maryland, D.C., and Virginia, Northern Virginia. And so his work is not performed in a single state. Maybe he lives in D.C., so he also works out of his house. Then the question is, where did he report wages? Well, if he works in the base of operation, which is Maryland, then you report it to Maryland, okay? Even though he has additional work and it's not localized to a single state. Okay, so now that doesn't work. Let's say the person you have someone that works in New York. And they do New York, they do New Jersey, Connecticut. Sometimes they work out of their house. He doesn't work in a single state. He doesn't work in the state where the organization is based, the base of operation. So now he works from another state where he receives direction and control. So if he works out of, in this condition, and he receives direction and control from New York, you report it to New York. Okay? So again, and then if you have someone in California who doesn't work in a single state, so he does the West Coast, he doesn't work from the base of operation, he doesn't work from places he receives direction and control, then and only then would you report it to a state where he's living or he resides, and that would be California. So important then to pay attention to that, what state. Once you do that, then you can determine, once you know the state, then you can determine the state taxable wage basis and pay attention to that. 5, assess your UI claims activity to ensure UI claims are timely received and processed. So when you're looking at claims coming in, are they going to the right person? If you have it sitting on other people's desks and going to the wrong department, you need to pay attention to that. Often now consider the electronic receipt, so they're sending it to a designated person that you electronically identify. More and more states are doing that now. Ensure required separation. Payroll information is available and accurate. So make sure when a person is separated, you have that information available for the individual completing the UI claim form. Ensure all UI claims are timely and correctly completed. Review and appeal incorrect determinations. Notify U.S. state agencies of rehire. So if someone is laid off and you rehire them, you have a requirement to notify the state in 20 days. So that's something you have to do. Notify the state UI agency of any job refusal. We talked about job refusal a minute ago. 6, assess your UI hearing management activities. Ensure documents are available for hearings. Ensure witnesses are available and prepared for hearings. Attend UI hearings. And then review and appeal incorrect decisions. And make sure when you look at the decisions that you get, either the determination and or the decisions, you read the whole decision. Don't just look at whether they grant benefits or not. Read the whole decision to make sure that the material, that the write-up is correct. Because if they don't, remember with collateral estoppel, once that becomes final, you can't correct it. And if they've misstated something, you're going to have to live with that. And so very important that you read the whole decision. And if you disagree with parts of it, that's what you need to appeal. Review and assess your management activities. Ensure effective hiring procedures. Effective performance management appraisals are in effect. You ensure proper and effective documentation. Documentation becomes an important part of this process. Ensure discipline and termination procedures have been identified and correctly followed. Make sure you train and keep your supervisor managers up to date on these issues. I mean, there's numerous things you have to train supervisor managers on. One of them is for those involved in UI activities and separating individuals, that they understand the role that they're playing in importance. Develop some UI metrics and key performance indicators. Measure the UI cost performance on your organization, something that you should do as well as your financial department. And then finally, hold supervisor managers accountable. There's something called internalized experience rating. So where you have a large organization, multiple divisions, a number of people and departments contributing to your UI tax rate, it may be important to internally break them into experience these individuals, because you may find that a specific profit area, a specific division or department is actually determining and causing the total rate to be affected. And so something to pay attention to for large organizations. Okay, come on. Okay, then what I included here, we're not going to go through it, is the audit, some audit questions from the employment labor law audit on unemployment insurance. So look at these questions and answer those. And then I actually have a case study here that we're not going to have time to go through now. But that ends this part of the discussion. Let me turn it back and see if anyone had any questions or comments, thoughts that we need to discuss.
Yeah, so that was a great session, Ronald. We will now move to the Q&A and take questions from the audience. I request all the participants to place their questions in the bottom right-hand corner of your screen, in the chat box. Ronald, let's just wait for 5 minutes here to see if you're receiving any questions.
Okay, let's see if there's any.
Again, participants can post their questions in the chat window in the bottom right-hand corner of your screen.
Okay, well, I don't see any questions. So here's my contact information. If anyone has any thoughts, comments, or additions you want to add later on, please feel free to reach out to me. Either give me a call or send me an email. I'll be happy to respond.
Yeah. Okay, so no questions. So, yeah, we'll find up the session here today. Yeah, great. This is Manny with Amerant Education. We would like to thank you very much for your participation today. We hope the program to be of value. And this concludes our presentation today on unemployment insurance, managing key issues in response to COVID-19 implications. Same time, should you have any questions, please feel free to contact us on support@amaranteducation.com. Thank you, Ronald, for your presentation today. And thank you, everyone, once again. Have a great day. Stay safe. Take care.
Okay. Bye, everyone.